Every empire claims that its currency is secure. Every government affirms that its commitments will endure indefinitely. Yet each time, history demonstrates otherwise. From Rome to France, from the Confederacy to contemporary Lebanon, individuals have awoken to discover their savings devalued, their earnings trivial, and their prospects taken away by systems they believed to be reliable. Collapse is not an anomaly. It is the norm. The critical inquiry is not if financial systems will falter, it is how one safeguards oneself when they do. The belief in permanence is the most perilous financial error of all. We examine our bank accounts, our national currencies, and we presume they are a solid foundation. However, money is not a foundation. It is trust, and that trust can disappear in an instant. This is why history can be so harsh and insightful. Each downfall leaves a path of teachings, trends, and alerts regarding what truly safeguards wealth and what dissipates into nothingness. If you observe carefully, you will notice that those who endure these calamities were not the ones with the deepest trust. Instead, they were the ones who questioned first. Consider the Byzantine Empire, often viewed as the eastern segment of Rome that astonishingly endured for 1,000 years after the western half collapsed. Central to its economy was the gold solidus, a coin so trustworthy that merchants throughout Europe, the Middle East, and Asia accepted it readily. For hundreds of years, it represented the closest equivalent the medieval world had to a global reserve currency. However, here's a detail that loyal viewers will find intriguing. One might assume they would have taken lessons from Rome's earlier failure with the silver denarius, where emperors repeatedly debased it until it resembled little more than tin covered in a layer of silver. We've recounted that tale before. Yet, remarkably, centuries later, the Byzantines repeated the same error using gold. They started to diminish its purity, making it thinner and incorporating less expensive metals. Initially, nobody paid attention. Later, trust began to fracture. The coin that had supported trade in the Mediterranean turned into just another political illusion. The act of debasement eroded its trustworthiness, leading the Byzantine economy to lose the stability it had formerly enjoyed. What remained? Not the promises on paper, nor the declarations from the government. Merchants who had discreetly accumulated real gold or held land beyond the empire's control safeguarded their wealth, while the rest watched their money diminish. This presents the first timeless lesson. Governments often fall prey to the allure of diluting their currency, and when they do, genuine value migrates to assets that cannot be forged. The American Civil War is recalled for its military engagements, political maneuvers, and the end of slavery. However, beneath the clashes and rhetoric lay a harsh financial struggle that many contemporary Americans hardly comprehend. Both the Union and the Confederacy realized that conducting a war of such magnitude necessitated the issuance of currency. In the North, the government introduced greenbacks, paper money not supported by gold, but by the commitment of the United States itself. Initially, this initiative appeared courageous and patriotic. Nonetheless, as more greenbacks entered the economy, their purchasing power diminished. Inflation decreased their worth, and faith in the currency began to falter. In the South, the situation was even more dire. The Confederacy, in urgent need of resources, printed graybacks in enormous amounts. By the conclusion of the war, inflation in the Confederacy had reached staggering heights, prices skyrocketing by thousands of %, and wages barely enough to purchase anything. Soldiers' paychecks became worthless almost before they could be utilized. Families were burdened with bags of currency that could scarcely buy a loaf of bread. By 1865, Confederate money had become more than just feeble, it was essentially worthless. In that collapse, tangible assets held the most importance, not the empty promises of paper money. Real possessions, like land, food, and gold, retained their value, while currency turned into nothing more than a cruel joke. For many ordinary Southerners, this situation was catastrophic. Lifelong savings turned to dust. Meanwhile, for those looking to exploit the situation, who had access to physical goods, the war presented an opportunity to acquire property and wealth at drastically reduced prices. It is a lesson that Americans seldom receive, yet must always remember. Their nation has previously experienced a collapse of its currency. When this occurred, safety did not arise from relying on the money in your wallet, but from possessing assets that the system could not devalue. France presents a harsh example of how revolutions can undermine currency more rapidly than any conflict. conflict. In the 1790s, as revolutionists dismantled the monarchy and confiscated church properties, they introduced a new paper currency called the assignat. These notes were meant to be backed by the value of the seized assets and stabilize the economy. However, the government recklessly printed them in excess. Each new release devalued the previous ones. Prices soared, wages lagged behind, and before long, the assignat lost all its value. Farmers demanded products or silver instead of paper currency for their food. In Paris, bread riots re-emerged, resulting in the revolution consuming its own. The individuals who prospered in this downfall weren't those possessing patriotic currency. They were the ones who owned tangible assets like food, gold, or real estate, items that the government couldn't fabricate. For the average resident of Paris, the realization arrived too late. Assurances, regardless of their idealism, hold value only as long as others recognize their worth. When trust erodes, your savings don't merely diminish, they disappear. However, not all collapses are the result of rulers making changes to currency. Occasionally, they arise from sudden shocks that appear unexpectedly. During the mid-14th century, Europe was hit by the deadliest pandemic in its history, the Black Death. From 1347 to 1351, up to half of all Europeans perished. Cities were deserted, villages disappeared, and trade routes fell apart. Nevertheless, the economic impact of the plague is more nuanced than just outright disaster. As half of the workforce was lost, labor became a valuable resource. Those who survived were able to demand higher wages. Food and land, which were previously limited, became relatively plentiful in comparison to the population. Families with cash reserves, whether in the form of silver, goods, or simply the capacity to work, found themselves with unexpected leverage. Properties that were once prohibitively expensive could now be acquired at a fraction of their former cost. Homes were left empty, fields lay fallow, and those remaining were in a favorable position as buyers. If this sounds unsettlingly familiar, it should. During the COVID pandemic, we witnessed a contemporary iteration of this. Disruptions in supply chains, governments minting trillions to prevent a complete halt, and a surge in inequality as those with cash reserves seized opportunities, while individuals living paycheck to paycheck fell further behind. In the United States, housing prices skyrocketed. Stock markets rebounded almost immediately, while countless ordinary citizens struggled to meet their rent obligations. The pattern is evident. Pandemics alter the distribution of wealth. This has always been the case. Those who survived the Black Death took advantage of the scarcity to improve their social standing. Individuals who weathered the COVID pandemic with financial resources acquired real estate, shares, and enterprises that others had to relinquish. The takeaway is unsettling, yet it is accurate. Emergencies benefit those with savings and disadvantage those without. While pandemics illustrate how rapidly shocks can disrupt an economy, the banking failure in Renaissance Florence reveals an equally important lesson. Institutions that seem invulnerable can collapse unexpectedly. In the 1340s, Florence stood as Europe's financial hub, home to influential banking families like the Bardi and Peruzzi. These banking houses had made significant loans to monarchs, most notably to Edward III of England, who defaulted on substantial debts during his conflicts with France. Once Edward ceased payments, the banks faced ruin. Depositors lost everything. Trade came to a standstill. Florence, which had once enjoyed great wealth and influence, descended into disorder. The average citizen who had placed their trust in the city's powerful banking institutions discovered that being large did not equate to safety, and that a good reputation did not guarantee protection. What have people discovered? That the idea of being too big to fail is a deceit that has persisted throughout the history of finance. Organizations are designed to generate profit, not to ensure your security. When they collapse, your savings will go down with them. This lesson resurfaces every century, from the Florentine collapse to Lehman Brothers in 2008, and to the Lebanese banks freezing accounts in 2019. Those who survive are the ones who understand that the promises of an institution hold value only until they no longer do. Jump ahead 200 years, and the same lesson resurfaces in Asia. In 1997, a speculative assault on the Thai baht escalated into a regional crisis. Thailand had taken on significant debt in dollars, assured that its currency peg would remain stable. However, when it failed, foreign currency debts became impossible to repay almost instantly. Investors hurried to withdraw their funds. Currencies throughout Southeast Asia, including Indonesia, Malaysia, and South Korea, plummeted in a domino effect. Economies contracted, unemployment rates skyrocketed, and governments pleaded with the International Monetary Fund for assistance. The individuals who bore the brunt of the fallout were not the global hedge funds that ignited the turmoil. It was the everyday citizens, whose savings diminished in value, whose mortgage payments surged, and whose jobs disappeared. The pattern was all too recognizable. Those who possessed dollars or foreign assets fared better than those who relied on the local currency. Countries reliant on external debt found themselves compelled to implement austerity measures, while Wall Street firms seized opportunities for cheap acquisitions of Asian assets. What initially appeared to be a local disaster was, in reality, a worldwide shift of wealth. The lesson resonates through every financial disaster from Byzantium to Argentina. Borrowing in foreign currency can lead to significant peril. When a crisis strikes, it's not the lender who suffers, it's the borrower. At this point, the message should be evident. Regardless of whether it's the French Revolution, the American Civil War, or contemporary Asia, the same patterns emerge. Paper currency fails. Debt binds both countries and households. Ultimately, it's not those who have the greatest faith in the system that endure, but rather those who see its vulnerabilities before it breaks. One of the most unsettling aspects of history is that the collapse is not confined to the past. It is occurring right now. In Lebanon, from 2019 to 2021, the banks implemented what many in the developed world still find hard to believe. They shut their doors. Citizens woke up to discover that their deposits had been frozen, withdrawals were restricted, and their currency was in free fall. The Lebanese pound plummeted in value by over 90%. A lifetime of savings was reduced to mere pennies. People queued outside banks, pleading for access to their own funds, only to be told their money was unavailable. This situation affected not only small savers, but also larger accounts. Middle-class households, retirees, medical professionals, and engineers, all of whom had faith in the system, were devastated. The message was harsh and unmistakable. The money you have in the bank isn't a secure stash. It is a loan you've extended to an institution that can choose, during a crisis, not to reimburse you. Those who fared the best were individuals who had either invested internationally, possessed tangible assets like gold or real estate, or maintained cash outside of the banking system. Everyone else found themselves stuck. If this feels distant, it really shouldn't. In 2008, Americans witnessed the repossession of their homes and the destruction of their pensions, all while the banks that triggered the crisis received bailouts. In 2020, in response to the pandemic, trillions were printed to sustain the economy, a lifeline that inflated asset values for the wealthy, leaving the wages of ordinary workers unchanged. In 2023, regional banks in the US suddenly failed as depositors lost trust, serving as a stark reminder that the idea of too big to fail is merely a comforting story we tell ourselves until the moment reality hits. How can one safeguard themselves when everything disintegrates? History reveals that there isn't a one-size-fits-all solution. In Byzantium, wealth was measured in gold. Following the Black Death, having cash to purchase deserted land was key. In Florence, it was advisable not to place faith in too-big-to-fail financial institutions. During the Confederacy, tangible goods were essential. In France, the focus was on securing food and real estate. In Asia, the strategy was to steer clear of debt in foreign currency. In Lebanon, it meant withdrawing funds from banks before they shut down. While the specifics may shift, the overarching lesson remains the same. True survival stems not from blind faith in currency or institutions, but from understanding what genuinely possesses value when illusions unravel. Here's a thought-provoking idea. Collapse is simultaneously a disaster and a chance. For those who are unprepared, it spells destruction. However, for individuals with resilience, liquid assets, or resources that cannot be devalued, it presents an opportunity to gain wealth at significantly reduced prices. Following the Black Death, many peasants became landowners because there was an excess of land and a shortage of people to cultivate it. While the specifics may shift, the overarching lesson remains the same. True survival stems not from blind faith in currency or institutions, but from understanding what genuinely possesses value when illusions unravel. Here's a thought-provoking idea. Collapse is simultaneously a disaster and a chance. For those who are unprepared, it spells destruction. However, for individuals with resilience, liquid assets, or resources that cannot be devalued, it presents an opportunity to gain wealth at significantly reduced prices. Following the Black Death, many peasants became landowners because there was an excess of land and a shortage of people to cultivate it. The baker who could still bake bread, the craftsman who could fix tools, the farmer who could nourish a community, and the merchant who could transport goods across borders. These individuals not only endured crises, but thrived amid them. During times of turmoil, money becomes less relevant, but production always retains its significance. People continue to require food, construction, trade, and the necessities of life. Those who can fulfill these demands will not remain impoverished for long. That's the deeper protection. Not blind faith in institutions, not the hope that governments or banks will save you, but the combination of real assets, real skills, and the awareness that illusions always collapse. Every crisis is a transfer, from the many who trusted to the few who prepared, from paper promises to tangible value, from passive savers to active builders. History has shown this pattern again and again. So the question is not whether everything falls apart, it always does. The question is whether you will be one of the many left holding promises or one of the few holding something real. History doesn't repeat, but if you ignore it, it will crush you all the same. If this provided you with a fresh viewpoint, consider subscribing. The past holds the solutions. I'll guide you on where to search.